Welcome to the JMJ Commercial Realty Podcast. Dive into market insights, winning strategies, and the stories shaping today's commercial real estate landscape. Let's get started.
All right, hello and welcome everyone to the JMJ Commercial Realty Podcast. My name is Adam Schertzer. I'm an advisor at JMJ Commercial Realty. I'm joined here by the broker and owner, Josh Cedia. How you doing, Josh?
Hey, Ed, doing well. How are you?
Good. And we have a special guest here today. I'd like to welcome Arif Bhimani from Middlesex Bank. Thank you for joining us, Arif.
Thank you, Adam and Josh. A pleasure to be here.
Thanks,
All
Reef.
right. So, Arif, if you want to just tell us a little bit about yourself and what you do at Middlesex.
Yeah, thanks, Adam. At Middlesex, I am a commercial lender, and part of my purview is is financing for buildings that are either uh, owned and occupied by a business or owned and rented by an entrepreneur, investor, landlord, insert, whatever you want to call that. We call that investment real estate. Um, I've been with Middlesex for about 14 years. Um, and I've had the pleasure to have networked both with you and Josh over the years. And you guys have been great partners, both when I need to send a client to you for brokerage guidance, as well as being a resource to you guys when you need to send your clients to the bank for financing or a bank for financing. So it's a pleasure to be here, and I'm looking forward to the call.
Great. Sounds excellent. So I know we're going to kind of split this up into two parts. The first one we're going to talk about is investment real estate. So why don't we get into that right away? What is investment real estate?
Well, investment real estate is any real estate that an owner or entrepreneur holds and plans to rent out the units. Um, that could be commercial or residential tenants. Some examples could be a single family house that's not owned and occupied by the owner's family, but rented out. Other examples could be a multifamily, like a duplex or a triple decker or even a complex. Um, and those are various examples of residential investment real estate. Some examples of commercial investment real estate could be an office complex, a strip mall, a retail facility. And a retail facility, like I said, could be a strip mall, or it could be a big warehouse or big box store. Or it could be a multi-use facility. The point is that the occupant is a tenanted occupant and is not the owner. And typically we are financing to the owner of the property.
Yeah, it all makes sense there. So I know on our side, we might get a client that comes to us and says, I'm looking to invest in commercial real estate. And some of the first questions we ask them is like, have you talked to a lender yet? Do you have, a certain amount of funds put aside, all this stuff like that before, we even want to get out there and start showing them properties, whether it be something for, $300,000 for a little commercial condo or a $5 million
Mhm.
building. So I know like this, where a lot of times we would say, okay, let's have you talk to your lender first. So if we send someone to you like that maybe this is the first time that they've, even thought about investing, how do you start that conversation? What kind of questions do you ask them?
That's a great question, Adam. You typically, for a first time entrepreneur, what there are some intangible and tangible questions that we might ask, and I'll get to those. Some of the tangible questions we might ask is um, their affordability in a certain property. And their affordability of a certain property, by and large, means their ability to provide a down payment. Um, and what that means is that the bank is not going to finance a property 100%, as you both know. The bank in most investment properties may go to a maximum of 80% financing, but more comfortably 75 or 70% financing or lower. That means that the first question, and I think you guys asked this as the first question of when a new entrepreneur is shopping for this investment property, is do they have that 20, 25, or 30% down payment? And by virtue of that number, they can determine what what the purchase price of the property is that they should be targeting. So let's use a basic example. If they have, and this hopefully is not their entire nest egg, but if they had $250,000 of down payment towards this potential investment, then maybe they are qualified to look at a property in the 900,000 to a million range. And then we could, extrapolate above and beyond that, given that. So that's that's a very, very important factor for us. There's some intangible things that I think are very, very important for a first time investor in investment real estate. And I hesitate to use the term landlord, but for the purposes of this discussion, I think it is. Some people consider that a dirty word. But part of the intangible analysis is, and many people will say that this has nothing to do with banking or brokerage or finances, is really what kind of landlord are you suited to being? Are you capable of being a landlord to residents or residential real estate? Are you capable? Is it in your personality to be a landlord to um, um, a retail property? And as you can imagine, there's a whole host of answers to that. And not everybody's personality is suited to that. Not everybody likes, a phone call that something needs to be repaired, or not everybody has the ability to collect and organize rent payments. But I think that once someone exhibits that understanding that this is not just an investment, but there's a business aspect to it, then we're more comfortable moving forward, if that makes sense.
Mm-hmm.
I think those are two great points. I mean, you look at the financial ability to purchase and kind of what range for pricing, and then also their appetite for managing, certain type of property, unless they're going to get a property manager or something,
Mhm.
but that,
Yeah.
it's just important. So, yeah.
Yeah, and just a note on getting a property manager, that is a skill in and of itself, right? And that's also an expense. But maybe that's the best thing for some people. But understanding that this is not a 100% passive investment is um, uh, said differently. My most successful property owners understand that this is not a 100% passive investment.
Yep.
Definitely. Now so say we get that out of the way, say they have the money, they come to you, okay, you can afford this property. What
Mhm.
what would be next as far as, that the bank would look for? I'm thinking stuff maybe like cap rates, or,
Mhm.
if there's a tenant in there or not, or what the rental rates could be. Like how much,
Yeah.
does the bank loan play into that for giving them a loan
Yeah.
or not?
Yeah. So that then becomes the financial analysis of the building. Okay. The first, again, taking a step back, the first thing that we want to know about the buyer is that their ability to afford the down payment. But we also, like we said, we want to know perhaps their personal financial history as well, right?
Mm,
Regardless of this particular loan request, um, someone with a strong personal financial statement, someone with a strong FICO score, or a group with a strong personal financial statement is going to be a better borrower than a group or an individual with low financial scores or an insufficient personal financial standing. So once we pass, and we can come back to that if you'd like, Adam, but once we sort of are comfortable with the ownership, we want to be comfortable with the building. And what we like to see is that the building's cash flow will support the loan payments. And what do I mean by cash flow, Adam? I mean that um, the cash flow is the rent minus the expenses equals cash flow or equals profitability or equals free cash to service debt. So getting away from cap rates and other things that might be important to how investors look at buildings, we look at whether cash flow can support the loan. So we tabulate all the rents of all the units, all the expenses that are paid by the ownership, and we basically do a profit and loss report for the building. And I think that the prospective owners and you, I know that you guys as brokers do that as well. Um, because that really is the second part of analysis. Now, when there comes to rents, there are many, many situations where previous rents may not indicate what future rents might be. For example, if the building is going to be improved, if the rents were under market, if there were vacancies in the building. And those are all valid discussions to have with the lender. And if the lender becomes comfortable that in a situation where maybe the historical cash flow isn't representative of the future cash flow based on certain changes to be made, then we'll look at that situation a little bit more positively. But that is a discussion to be had. But apples for apples, we want to look at that the cash flow does support the potential loan. And again, not every for any given building, and you guys know this better than anybody, the loan isn't the same for every owner, right? Some owners may have a bigger loan. Some owners may be requesting a smaller loan. Some owners may have a better personal financial standing. Some owners may have. So there's a misconception that, I'll just use the names Adam and Josh. Adam went in for a loan on building on 1 Main Street and got approved, but Adam didn't move forward with the deal for whatever reason. And along comes another entrepreneur, Josh, and said, well, Adam got approved by Bank XYZ or Middlesex Bank, so this should be a layup for me. It's not the same. So the two factors are strength of ownership as well as a financial analysis of the building. And the two situations are not the same when one variable changes.
No, it makes sense. That's great. So now I think another question some people might have is how long does this all take? From we help them find a building, they go to you for financing. I know in residential real estate, sometimes you can close within a few weeks to a month if you're buying a house. But definitely where the commercial real estate can take quite a bit longer than that in certain situations. And if you want to just shed some light on, timeline.
Yeah. The timeline does take a little bit longer because we have 3 phases of the approval process or the time to close process, if you will, Adam. And that is the financial analysis of the ownership as well as the building. That is the appraisal process of the building, and we can come back to why the appraisal is important. An environmental sign-off, which I added that step. It's really concurrent with the appraisal process and the legal process, giving the engagement to a bank attorney to close the loan. So if we break those steps down in a situation where there are no issues, once documentation is all received by the bank, an approval could take 2 or 3 weeks. The bigger the property, the perhaps longer the time the bank might take to review that particular request. For example, a $500,000 loan request would take a shorter period of time than a $1 million loan request would take a shorter period of time than a $3 million loan request would take a shorter amount of time than a $6 million loan request, because every bank has different levels of scrutiny. Every bank has different levels of credit review based on monetary risk, or size of risk. But let's just say, for the purposes of this discussion, and this is based by and large on the deals that the three of us have done together over the years, that we could get to a financial approval within about 3 weeks. Then it would probably take us another 3, perhaps 4 weeks, to get the appraisal in. Commercial appraisals take a little bit longer than residential appraisals, or residential owner-occupied appraisals, because anecdotally, there are fewer appraisers in that space. They have to be bank-approved appraisers, and there's a little bit more involved in a commercial property than there is in a traditional single-family home. So that could take 3 to 4 weeks. So that puts us right around 7 weeks total.
Mhm.
And maybe if we have started the legal process, possibly concurrently, I would add another 2 weeks to that. So by and large, I would say 8 to 9 weeks is a good target from start to finish. But as you know, if things get delayed in document collection, in the appraisal process, in the legal process, then that could add time to that timeline.
Very informative. It's great. Thanks, Reef.
Mm-hmm. Yeah, I know we only got about 5 more minutes left here. Josh, did you have any other questions for Arif?
You mentioned the loan size, and kind of it could take a little bit longer based on that piece of it. Do you find, from your experiences, are there other things that kind of come into play when you're dealing with larger size loans? Is it a little bit of an maybe easier process when you deal with certain types of commercial or certain loan amounts? So just kind of curious around that.
I would say the way that the bank looks at that kind of thing, Josh, is when there's a larger loan, and one man's large loan versus another man's large loan may not be the same number. Um, but if a particular loan is being reviewed by any bank and it's going to different levels of credit committee, and credit committee is our way of saying underwriting, and based on the size of loan, it has to go through several layers of underwriting. Things that can help that entrepreneur are having been a previous property owner, having property management experience elsewhere, and having a strong personal financial record. So experience, history, having done it once before is a good indication that you're ready for that level of risk, not just that you can afford it. So that would make those kind of factors would help the process a lot. And therefore, the bank would look favorably upon that borrower, as opposed to really scrutinizing someone who's doing this for the first time.
And if it's an experienced borrower, and maybe client of the bank, do you find that sometimes the amount down could be less than, a new borrower, just because?
Yes, definitely. I mean, any institution is going to look at previous history, the relationship with that borrower favorably, right? If we have a 5-10 year history with an entrepreneur group or an investor group that has bought and sold properties before, or not necessarily sold, has a history of making the payments, has a history of providing us with the financial records that we've asked for, we've met with that person or that group, those are all favorable points. And that's called that is essentially the definition of relationship banking. Um, and we hope to develop that relationship with um, with new entrepreneurs, but certainly someone who has, or a group that has a relationship with the bank is going to get not necessarily favorable terms in terms of like the bank's going to violate our exception policy, but if there's a consideration of having to put down 20% instead of 25%, we'll look at that very favorably. Um, because not only do we have history, but we might have other collateral with that particular group through other properties that we financed. So yes, relationship does matter tremendously.
Mhm. Excellent. And for Middlesex, when you kind of think about, generally the types of clients that you work with, is it a lot more uh, on the user of commercial space or investor, or it's kind of a split? How do you think about that, for clients that you help?
I'd like to say it's a split, but I think the market, um, if you look at the market, there's far more investment real estate out there than there is commercial owner-occupied real estate, and that ratio probably reflects in our portfolio as well. I don't necessarily have that number, but if I go back and look at perhaps a cross-section of 20 um, loans that maybe I've made in the last year to 18 months, probably 13 or 14 were investment real estate, and six were commercial real estate, meaning the owner's business is occupying. I don't know if that's your question,
Yeah,
but I think that would be a non-scientific ratio, if you will, and that probably is a reflection of the market itself.
Mhm. At whatever kind of point in time with what's going on with the market.
Exactly.
Yeah.
Yeah. And that lends us well to wrap this one up and move into our next episode, where we will be talking about more owner-occupied real estate. So I just want to thank you, Arif, for being here with us. If people want to contact you, what's the best way to reach out to you at Middlesex there?
Well, Adam and Josh, thank you for having me on this episode of your podcast. Certainly, your viewers or listeners can contact me. The best way to contact me is by email, which is arif.bhimani@middlesexbank.com. Um, and I'm sure you guys will share that in the notes.
Hmm.
But I'd be happy to hear from any of your contacts and be a sounding board to any questions that they might have.
That's great. And if anyone wants to contact Josh or myself about this podcast, about this episode, or any other episodes, or have any suggestions, you can reach us at podcast@jmj-cre.com. And thank you, Arif. Thank you, Josh. I think that about does it for this episode.
Thank you very much, gentlemen.
All
Thank you.
right. The views, thoughts, and opinions expressed on the JMJ Commercial Realty podcast are those of the host and guests and do not necessarily reflect the official policies or positions of JMJ Commercial Realty or its affiliates. The information provided in this podcast is for informational and educational purposes only and should not be considered financial, legal, or real estate advice. Listeners are encouraged to consult with qualified professionals regarding their specific real estate or business needs. JMJ Commercial Realty makes no representations or warranties as to the accuracy, completeness, or suitability of any information discussed. Reliance on any information provided in this podcast is done solely at your own risk. By listening, you agree that JMJ Commercial Realty and its representatives shall not be held liable for any losses or damages resulting from the use of information shared.